Blog Talk Radio.
And good morning from Orange County, California. This is Brian Dooley, CPA with Tax Talk. And as many of you know, I am a fan of the virtual world. So my assistant and almost co-host is Rob, my robot. Rob, how are you doing today? This is such a nice day. Just how are you doing, Rob?
Brian, I am feeling fine. Thank you.
Well, good. I know you worked a lot getting ready for this show, and I really appreciate it. Last night we had the Speaker of the House make a statement that I want us to listen to very carefully, because it's kind of like Reagan says, "Watch my lips," but here watching the lips is to find the the loophole Congress plans to use to increase our taxes. So, Rob, can you look for your notes?
Yes. Brian, I will find it.
Okay, tell me, so, pull up what happened last night and give us a report.
Well, Brian, here is what happened last night, according to ABC News. Raising tax rates is unacceptable, said House Speaker John Boehner as he prepares to open negotiations on the looming fiscal cliff with the president and congressional Democrats. Raising tax rates is unacceptable, Boehner said in his first broadcast interview since the election Tuesday. So, Brian, the tricky words are tax rates. Let me find my notes on a hidden internal congressional report.
Okay. When you look for that, and I want to kind of focus on that as Rob looks for those notes. So this is kind of the theme from the Republican Party, and I'm believing the Democrats are going to like it. The theme is, we are going to pretend like we do not have a tax increase, because we're not going to increase the tax rates. But we are going to increase your taxable income. And the way we're going to do that is we are going to remove a lot of the deductions that you take on your return in computing taxable income. And what they're targeting is the itemized deductions. And this is a target not just against small business, it's a target against everybody who owns a home, who pays state income taxes. And ironically, it will affect the wealthy the least, which is fine for me, but I like the idea that we all kind of get the same effect here. So what Romney proposed was that your total itemized deductions cannot exceed $25,000. And for many people, especially on either the East Coast or West Coast, where homes cost so much, the home mortgage generally exceeds that amount. So, Rob, if you have had a chance, can you tell me what we should expect now that the election is over with?
Well, Brian, both parties have quietly announced big changes. The big change will be cutting individual income tax breaks. The Republicans want to have an overall limit on deductions such as the ones for home mortgage interest and state and local taxes and donations to charities. The Democrats want to do the same, but only for top bracket taxpayers. Ironically, the Democrat proposal will have almost no impact. I mean none. Nada. The alternative income tax rules apply to the wealthy. The only change is that the Democrat proposal will disallow charitable donations. they see giving money to a charity as a loophole. On the other hand, both parties want to reduce the corporate income tax rate.
And the corporate income tax rate reduction has to do with creating jobs, which is very nice. The reduction of individual tax rates has to do with helping small business as a separate function, as a separate tax person, even though most small businesses report the income on their individual tax return, but at that level to reduce their overall tax. The European corporate tax rate is substantially less than ours. So if America wants to get Europeans to open a business here, our corporate tax rate, which is the form that a foreign business uses in the United States, is a corporation, needs to be competitive. So that's going to help big American corporations, those on the stock market. So if you're a stock market investor, you can see a bigger net income after taxes. Hopefully it's going to get in some European businesses who want to escape Europe's chaos and not to get hit with a higher tax rate. But for small businesses, this is an opportunity for you to sidestep the effect of the limitation on your deductions, which in effect is going to increase your taxable income. And this is done by creating a new corporation. You're going to have it as a separate taxpayer. By that I mean you're not going to elect to be a pass-through like a Subchapter S corporation. And it's going to pay tax at these lower tax rates. And the kind of income that this corporation is going to make is really based upon the small business owner using his innovative mind to place in that corporation an income-producing asset. So, for example, you are a distributor. You buy products and you warehouse them and you resell them. Your company has a fantastic inventory control program that has a tremendous amount of data. For tax law, that program is seen as a separate asset, and you can easily assign it to your new corporation and assign an employee to operate it or even subcontract that employee out from your own company and shift income from your small business, which generally is taxed as a pass-through on your individual tax return, over to this corporation. The other advantage besides shifting income to a lower bracket taxpayer, because this corporation will be in about a 18% tax bracket, is that corporations have some great tax advantages that only apply to corporations. The one that I focus on is a retirement plan which you get to fund with corporate stock. So instead of taking money, which is precious during this Great Recession, and causing a tax deduction, you merely go to your stock book, write out a few shares, hand it to yourself as trustee of the retirement plan, and you have a large deduction in this new corporation to offset its income. The other advantage is a corporation has a special type of health reimbursement plan, not talked about much at seminars. This plan is this law is an old law designed before we had insurance, and it allows a corporation to pay any type of health benefits, those primarily not covered by insurance. So if you're doing an alternative treatment, if you have a big copay, it gives you tremendous value. As a business owner, it's going to allow you to maybe change your employee's insurance plan to a different deductible where you reimburse them if they exceed it. So those are just two items. There are many, many more. I encourage you to get with your CPA, put on your innovative thinking cap, and push him to kind of think with you. You know, he may start to say, no, you can't do that, you can't do this. Push him to do some research, spend a few dollars on his time for him to go out and kick around the tires of the tax code and look at some of these great tax savings. Now, before we go, I want Rob to present to you his report on the Fiscal Cliff, because he's done a lot of work on it. Once again, going into some internal documents between congressional research. So Congress has a research department that does studies and gives kind of the inside story to the congressmen. So, Rob, what have you heard about the fiscal cliff?
Well, it is too soon to predict exactly what will happen to its benefits, or when. But my insiders tell me that lawmakers might agree before year-end to extend the current tax regime for 6 months to a year in order to buy time for major overhaul. But a tax extension is not a given. The threat of a fiscal cliff and the higher tax rates and spending cuts scheduled to begin in January absent a political agreement is looming. Each party is saying that overhauling the tax code could produce a simpler and more efficient system. The individual income tax brings in more revenue than any other federal item, about 47% of the total. Yet in fiscal 2011, the individual income tax raised $1.1 trillion, but lost $953 billion to itemized deductions. Brian, we should not plan to save taxes by tax deductions. For example, the Simpson-Bowles Deficit Cutting Commission and Mr. Romney both have suggested cutting tax rates if as deductions are pared back. Recently, 80 CEOs of major companies joined them, calling on Congress to enact comprehensive and pro-growth tax reform, which cuts tax breaks, lowers rates, raises revenues and reduces the deficit. The exemption for health insurance premiums resulted in an estimated $128 billion in lost tax revenue for 2012. Other big-ticket health exemptions include the deduction for medical expenses and the exemption for Medicare payments. Together they benefit a large swath of taxpayers. Be warned, they could be on the chopping block. The CEOs calling for tax changes also pressed lawmakers to limit the growth of health care spending. If the brake is pared back, many taxpayers will face sharply higher bills, experts say. According to a survey by the Kaiser Family Foundation, the average health insurance premium at firms with many higher-paid workers earning $55,000 or more in 2012 is $16,427 per family. An average of 3/4 of the total is paid by the employer, and that amount is tax-free. At many large firms, the employee's portion is also tax-free. Thus, both parties are looking at taking this fringe benefit by expanding the law that exists now to high-cost health insurance plans. Next year, the threshold for deducting medical expenses will rise to 10% of adjusted gross income for most taxpayers. Often people who qualify have very large expenses, such as for a nursing home.
So, what we're looking at is the employer will take the amount paid for the employee's insurance and place it as income on the W-2. The employer still gets the deduction. The employee has higher taxable income and does not have the money to pay the tax because the money went to pay insurance premiums. One of the goals here is to get employees to want cheaper insurance so they pay less tax. So there's a lot to look at coming down the road. There is 3 to 6 months before anything will be in place, and this gives the small business owner, the CPA, and their attorney time to set up these new arrangements, get some innovation going. If you have any questions, give me a call. I'm Brian Dooley. My phone number is 949-939-3414. I wish you all a great day, and please listen to our next episode.